Hello, everyone. So this video is to talk about the details, how to solve those practice questions that I gave you for midterm. And the agenda is like this. We're gonna talk first about the questions for chapter 1 to 4. Although chapter 1 is not included. And then we're gonna talk about chapter 5 to 7. Before everything, let me write it down here. So in the midterm, I already decided there will be 13 conceptual questions and 12 analytical. So it's almost a half and half. And again, as I talked in class, that for the conceptual part, I'm gonna maybe change the way I ask you, but if you study or understand fully the practice questions in the scope that I give you, you're gonna be fine. Understand fully means, for example, there is a multiple question. You have to understand each options, like each choices, why they are wrong, and you will be good to go. For the analytical questions, I already gave you some examples in class that you will not see exactly the same questions like we did in quizzes. For quizzes, I just copy paste the question and change the number. But in this real midterm, you're gonna see a little bit changed or revised question. Basically, it's like using for example, using the same formula but in a different way to back out different things. And I already mentioned that in class. So if you didn't come on Wednesday, you can ask around your friends to get a better sense of what exactly kind of example you can see. Okay, so then let's get started. I will focus more on the analytical questions, and I will pick some conceptual ones, maybe discuss more in depth, unless it's just about definition. For those like pure definition questions, I will just skip them because it's just definition. But some other maybe logic questions or a little bit deeper questions, I will talk a little bit more. Okay. And also Yuran is here. If you have questions or you have some questions that you want me to cover, please let me know and I will cover it.
Sure, thank you.
Okay, let's get started. So question 1 is from chapter 1, so it's not gonna test it, but it's just the definition of investment. Question 2 is also from chapter 1. It's about definition of financial and real assets. So I'm gonna skip it. Question 3 is from chapter 3, I think, like the IPO process. This is within the scope we're gonna test, so I will cover this one. Which is not true about IPO. If you remember, we covered in class that according to the data or empirical test, people find if you buy the IPO on the first, if you buy the IPO and on the first day, you're gonna earn very high abnormal return. It's around like 10 to 20%. So it's pretty high. But in the long run, IPO tends to underperform those matching firms. So if you don't remember that, you can go back to your, I think it's chapter 3 about security market. Like there is a slide showing that in the long run, 3 years holding period compared to the matching firms, IPO actually earns lower return. And I remember after class, I think some of you came to me, asked me, oh, suppose I short IPO firms, is it a good trading strategy? And I remember I told you the next class that it is underperforming, but it's not getting negative return in the long run. So for IPO firms, they still earn positive return, but it's just not as good as those similar firms or matching firms. The key takeaway here is that IPO have very good initial return here, meaning it's on the first day or first several days. But in the long run, if you look at 3 years or even longer, they have poor long-term returns. So this is basically the key takeaway. And I remember in class, I also mentioned, like, if the IPO earns very good initial return, why you cannot build a trading strategy to take advantage of that. And I don't know if you still remember that or still have the note, but it's about the oversubscribe versus undersubscribe. For oversubscribe, one example is like Airbnb. When it came out, I remember at the end of 2020, it was super hot. And as a retail investor, it's very hard to buy Airbnb before it come out. So because it's oversubscribed, you cannot get it you cannot actually earn the initial return. The initial return is not gettable. But undersubscribed firms, no, those firms that are not super famous, like you might not never heard about it. That's why they're undersubscribed. So for those firms, you can buy them. But the thing is, they are actually not performing really good. So you do not get the advantage of the high initial returns. In other words, the high initial returns are coming from oversubscribed firms. As a result, because they are hot and they are all oversubscribed and they have initial returns. So C is not right because A is right. IPO does not have good long-term performance. And D is right, it's just the mechanisms of IPO. So it's about like the roadshow, for example, after roadshow, the shares are allocated to institutional investors. So the answer is C. And the question D is just about the definition of balanced fund. So has nothing more to say. And question 5 to 6, it's a bit long and I will talk through it. It's an analytical question. So let's see. Mr. D wants to start a business or start an entrepreneurship. And there is a venture capital agrees to loan $1,000 to exchange for 70% equity. And Mr. D will retain the other 30% equity. And at the same time, Mr. D raises $2,000 in debt, who requires 5% interest at the end of the year. And suppose during the first year, Mr. D's company make a profit of $1,800. So think about it. You remember the order of payment. I assume you know that. So when a firm makes money, the first who gets the payment between the debt holder and equity holder is the debt holder. Debt first. And equity is the residual. We talk this in class. So in other words, Mr. D has to pay back debt first, and then whatever left over, he will split it between himself and the VC venture capital. according to the shares they hold. So because Mr. D make $1,800 of profit and it raised $2,000 in debt with 5% interest rate, meaning that Mr. D has to pay how much to the debt holder? 2,000 times 1 plus 5% equals to 2,000 plus 100 equals to $2,100. So Mr. D has to pay back $2,100 first to the debt holder or the lender, but he only has 1,800. What's gonna happen? He's gonna give all the money to the debt holder and announce bankruptcy, unfortunately. So then what is the lender's return? The lender's return equals to the payment he gets divided by, let me see. Yeah, divided by the initial investment minus 1. What is the payment he gets? Because Mr. D only have $1,800, so he only can get $1,800. What's the initial investment? It's 2,000 because he gave the $2,000 to Mr. D minus 1. Then the answer is minus 10% or negative 10%. So basically, the lender is losing money. Instead of getting a 5% interest rate, he's actually losing money. And suppose instead, during the first year of business, Mr. D makes a profit of $8,000. It's a lot. So in this case, what's gonna happen is that Mr. D gonna pay back the $2,100 to the debt holder. Then he will get $5,900 left, right? And then he will split 30% of it goes to Mr. D and 70% goes to the venture capital according to this percentage here. So how much goes to the venture capital is 5,900 times 70%, okay? Then let's look at question 6 first. Question 6 asks how much does Mr. D's business pays to the lender? It's just $2,100 because of what I just described. It includes the principal and the interest, okay? And what is the VC's return? Still return equals to payment divided by investment minus 1. What's the payment? Is 5,900 times 70%. What's the initial? Initial investment is $1,000. And the answer is 313%. Oh, okay, there is a minus 1 here. Let me double check if my answer is right. So yeah, so this thing equals to 413%. Remember, return has to minus 1 here. So your return is 313%. Okay. Oh, by the way, Yoran, if you have any questions, you can just interrupt me anytime. Don't have to wait.
Okay.
Then let's look at question 8. Suppose you want to purchase a treasury with a face value of $1,000. Assuming coupons are received semi-annually, how much money would you receive for each coupon payment if the coupon rate is 2%? I'm pretty sure I tested this question in the, I think it's in quiz, maybe like quiz 1 or quiz 2 somewhere. And also it's one of the practice question. So again, this coupon rate is annual rate, meaning that annually, what you get is 1,000 times 2% is $20. And because the coupons are semi-annual, so for each coupon payment, you get only half of it. It's just $10. Okay. Nine, is that true or false? Before tax yield for muni are typically lower than the before tax yield for the treasury bond. This is true because it's saying typically. I know there are some munis have very high yield. For example, Puerto Rico, we saw it in class. But most of the time it should be lower because of this equation. The munis rate or munis yield equals to 1 minus tau, or it's not equal, but yeah, muni does not charge you tax, so it's tax-free. And the de facto, I would say it's de facto yield you get, muni is just the raw one, but from the bond is 1 minus tau times RB. So suppose still it requires the like efficient market, or market is competitive. Suppose the muni has some like yield that is higher than the after-tax treasury bond. I mean, no, sorry. Suppose, because this question is asking you compare this RM and RB, right? Suppose the RM is higher than this RB, then after tax, the de facto yield you get from the treasury bond will be even lower than muni. Then there's no point why people buy treasury bond, right? And if no one wants to buy the treasury bond, the price of the bond will decrease, and as a result, the yield will increase again. So in other words, these two, sorry, these two should be approximately equal, so that people don't strongly prefer muni or don't strongly prefer treasury bond. Because if they strongly prefer any one of them, it will move the return, will move the price around. And the equilibrium or the stable period will be this equation approximately holds. So to make this equation approximately hold, the before tax yield for muni should be lower than this before tax bond, because the de facto yield you get from bond is after tax. Okay.
Is this formula in the slides?
Yeah, I think so. It's okay. I don't think on the slide is exactly the same, but again, this is, let me clarify. This is not a formula. There's no guarantee that they two should be equal, but based on the economic mechanism I just described, they should be almost the same. Otherwise, the price will move around. Does it sound reasonable?
What was that? The 1 minus 1
Oh,
minus.
yeah. This one, this is tax. tau is tax.
Oh, okay.
Yeah, I'm sorry. Yeah, because usually in the finance, like we most of the time use tau this notation for tax. So I just feel so natural to use it. I didn't realize that. Yeah, I didn't explain.
It's fine. Yeah, that makes sense. Thank you.
No problem. So again, like there is no guarantee that they two should equal, but in the equilibrium, they two should be similar. Otherwise, people will rush in to buy muni or rush in to buy treasury bond until they two are almost approximately the same. So there's no arbitrage or no free lunch opportunity. Yeah, and because of this equation almost hold, so muni before tax should be lower than before tax yield of treasury bond. And question 10, which of the following are the ways financial markets lead to better use of economic resources? It's just in the slide. It's literally like the first three are we covered in class and it's on the slide. If I remember correctly, it's chapter 3, I think, or chapter 2. Yeah, but efficient allocation of time, yeah, so it's irrelevant to financial market because financial market cannot make your time more efficient or time management. So it's just irrelevant. And the first three are right. Okay. And 11, investors will earn higher rate of return on tips. If you remember correctly, if you still remember, tips is inflation adjusted treasury bond. So if you remember the formula for real return, it's 1 plus nominal divided by 1 plus inflation minus 1. So real return is your real, the growth of your real buying power, right? People sometimes care more about real return because even if you make a lot of money, if you cannot use it to buy goods, it's useless. So if you think as if like you want a good real return rather than just nominal return, you will be concerned about the inflation. Say in real life, although you make maybe 5% return on stock market, but the price of grocery foods increased to 10%, then it's useless because you're basically getting more poor and you're basically losing money. So these tips will adjust the nominal return according to the inflation. So when inflation is high, these tips will give you a higher nominal return so that you can guarantee some level of real return, which is very nice, right? Let's see this question. The question says, investor will earn higher rate of return on tips than on equivalent default risk standard bonds if. So let's see the multiple choices. Inflation is lower than anticipated, meaning the inflation risk is not a problem. So the investors should not expect a higher return on tips. Okay. I think there's a table that should be N. So it's comparing the return of tips with some default risk, just a standard bond. And tips return will increase when inflation risk or inflation is high. And B is right because inflation is higher, meaning tips return will be higher because it's used to adjust for inflation. And US dollar increase against the euro irrelevant. Spread between commercial and treasury security remains low. This is about risk. This one is about default risk is low. It's irrelevant because at the end of the day, TIPS is a treasury bond. So it's default risk free at the beginning. And CD interest rates are typically high. It's also like related to default risk. So it's irrelevant. And 12, I think, is very simple. For 13 to 16, I will skip it because on Wednesday, I deleted the section for derivatives. But I want to emphasize here, the derivative section I deleted for midterm. It's not because it's not important. I deleted because I want to save you some time and energy on other things. It's very important because I'm gonna test you on the final. We will have another whole chapter on options and derivatives. So after the midterm, if you have time, you would want to spend some time on this, although it's just a little, it's gonna be later in this semester. So yeah, let's skip these questions for now. I said allocation is just a definition. A is definition, nothing to say. And 18 is about options, so I'm gonna skip. 19 is about federal funds. I also skip it, delete it. Surf City Software Company. Yeah, this is about definition of real and financial. So it's in chapter 1. Let's skip it. Okay, 21 is within our scope. You are comparing several bonds. The bonds mature in one period, so you will receive exactly one coupon and the principal. Assume you have two taxes. This one, 35% is federal tax and 15% is state tax. You observe the muni bond has 3% yield. Treasury bond has 2.8% yield. And corporate bond has a yield of 5.25%. Question 21 asks you to rank the bonds in terms of the after-tax yield. Is related to what we just talked earlier. Muni bond is purely tax-free. So after tax, the yield on muni will be 3%. And on treasury bond, it should be it should only charge the federal tax. So it should be and the corporate bond charges both federal and state tax. So the answer is, let me calculate. It's 2.9%. Okay, so this one is slightly lower than muni and higher than treasury. As a result, E is right. What yield, let's look at 2022. What yield should the treasury bond need to offer to have the same after-tax yield as muni? Suppose you should have RB and you want after-tax to be same as muni. So you want RB times 1 minus 35% equals to 3%. Then RB equals to 3% divided by 0.65. It's gonna be 4.622%. Yeah, very simple. And we will now test you about price weighting. So I'm gonna skip this one. Question 24. So it's about the limit order book. And remember, if you want to buy, these are the prices you look at as the investor. If you want to sell, these are the prices. Again, the ask price is the price that you as the investor want to buy and the dealer wants to sell. And on the other hand, the bid price is the price that you want to sell and the dealer is willing to buy. So let's see, if you want to sell, so you look at these two numbers. Which of the following is true? You want to sell 200 to 2,500 shares. And because at this price, you can only sell 2,000 shares, and the leftover 500 shares will be sold at the lower price, $15.07. So your average price will be less than $15.08. Okay. Fill in the blanks. When buying on margin, this one we're gonna test. You need to post more money when buying on margin. Okay, buying on margin meaning you bet the price will go up, and if the price go down, you're losing money. So you need to post more money. So this one is down. When you're short, you wish the price to go down. You're negative about the price. Then you will post more money when you lose, meaning when the price goes up. Okay. In order to buy or sell a security at a current price, it's not a limit order. Current price is market order. And limit order always have a price that differs from the current price. Okay, use the information to answer question 27 to 29. The current bid price for Tesla is $317.62. Ask price is $317.64. You purchase the stock and hold it for a year. During this time, you receive $5.25 in dividend and sell the stock for $321.25 at the end of the year. So dividend yield, your annual dividend is just this number, very simple, 5.25 divided by your buying price, which is the ask price, 317. Sorry, typo, 64. So the answer is, let me double check. Yeah, answer is $1.65. What is your capital gain? Capital gain is about the price appreciation because you sell it at $321.25 divided by 313.64 minus 1, it's equals to around 1.14%. So these are in the formula sheet. And your total return is very simple. It's just they two sum together, 1.65% plus 1.14% equals to 2.79%. Okay. Which of the following is true about the private offering? It's just in the slide. And the first two are on the slide. And the third one is not true because shares are traded on the market, meaning it's public. And this is private. Yeah, private firm versus public firm. Okay. And let's see 31 to 33. If you buy 100 shares of this company on margin, if you buy, and you maximize the amount that you borrow, how much do you borrow? So if you buy 100 shares, what's your total wealth? It's 100 times 50, $55,000, right? And the initial margin is 50%. So you will you can borrow 50% of this amount, meaning it's like $2,500. So 32 is actually following 31. If the stock price drops to $40 per share, how much do you need? So after you borrow and stock start to move around, you look at the maintenance margin, and remember, during the buying on margin case, what do you have? Buying on margin case, the margin equals to equity divided by total value, right? And remember, you borrow this amount. So maintenance margin is 45% here. And you have to maintain enough equity, and your total wealth here after drops to 4,000 is 4,000. And your equity, how much is it? It's 4,000 minus 2,500. So it's not like sorry. So this number should be always above 45%, but how much it is here? It's only 37.5%. So you definitely will receive a margin call. And because your maintenance margin is 45% and your total wealth is 4,000, what equity you should maintain is 4,000 times 45%. It equals to 1,800, right? And because after the price drops to 4,000, and you have to repay back the $2,500, your remaining equity. So this 1,800 is the maintenance equity you should have, but what de facto you have is here. It's only $1,500. This is what you have de facto. Then you have to pay $300 to make sure your current equity will satisfy the maintenance equity standard. Okay. And let's see, if you share, if you sell short 100% of the ready ink, given the information above, what is the profit if the stock price drops to $40 per share? Because originally you buy at $50, and again, when you're short selling, when price go down, you're actually making profit. So because it goes down $10 per share, you're making $10 profit per share. And because there are 100 shares, you're making $1,000. This is simple one. And 34 is about options, so let's skip this one. Bid-ask spread is an implicit cost to trading. So it is, and as I said in class, usually the ask price is bigger than the bid, meaning that if you buy something and sell it, buy a stock and sell it immediately, you're losing money. And the part that you're losing is the bid-ask spread, and it's also the implicit cost to trading. Think as if it's some profits that the dealer is trying to make. Like they are offering the bid and ask prices, so they want to make some price gap so that they can get some profits by trading with other people. Okay. And 36, this fund is a closed-end investment company. This is in chapter 4, mutual fund, with a portfolio currently worth in 300 million. So the asset is 300 million. Liability, 5 million, and 9 million shares outstanding. Liability is 5 million, meaning that the equity is 295 million. There are 9 shares outstanding. So per share, how much it is? It's 295 divided by 9 equals to 32.78 dollar per share. And this is the NAV according to the NAV formula, net asset value. If the fund sells for $30 a share, meaning that the price, the trading price of the fund is lower than the NAV, right? So how much it is lower? It's 30 divided by 32.78 minus 1. It's negative. So sorry, this one, this one originally is actually 32.777777 blah blah blah. So originally the answer would be around negative 8.47%. So meaning that it is sold as a discount of 8.47%. Okay, so because when you think about discount, you think how much percentage it is lower than the NAV. Okay. Advantage of investment companies to investors. This is in ETF, like chapter 4. All of the first 3 are just in the slide, nothing more to say. And this is ridiculous because you cannot get a guaranteed rate of return by investing in the investment banks, investment companies, because they are not bond, they are not fixed income fixed income assets. So those kind of like mutual funds or ETF are a little bit like portfolios or portfolio of stocks. It's not guaranteed. Okay. You short sell 200 shares of this company and it's now being sold for $50 per share. What's your maximum potential loss? Remember, when you short sell, you hope the price to go down. The lower, the more profit. Your maximum profit will be $50 if the price goes to 0. However, you don't want the price to go up. The higher the price goes up, the more loss you're facing. So suppose the price goes up to $60. It for you means $10 loss. And theoretically, the price can go any positive number. So as a result, your potential loss will be unlimited because the price might go to infinite, although it can never, but theoretically it can go all the way to the sky. So your potential loss or maximum loss will be unlimited when the price is infinite. Okay. Okay, let's see. Suppose you want to invest $1,000 in this first fund. What will be the initial value of your holding in this fund? This is testing you to remember use the front end load. because it charges you 1.5% when you enter this fund. This is what front end load means. When you enter the fund, you pay some fee. Because you pay the $1.5%. So after that, you will only have $985. Okay. E is wrong. The funny one. Suppose you have the same initial value of holding in both the mutual fund and the ETF. In 1 year, both funds are valued at $1,200. And if you sell both of them, so here you assume you just you have $1,000, ignore the front end, like maybe you invest $1,000 plus like 1.5% of it, but your final initial value is 1,000. Okay, so during this period, how much do you earn from investing in them after the expenses? This is basically what it's asking. So let's calculate the raw return first. You have like $1,000, and after a year they are valued at $1,200. So your gross return will be 1,200 divided by 1,000 minus 1, not minus 1 there, minus 1. So it's 12 divided by 1,000, and it's 20%. Oh, okay, I misread the question. Sorry, you actually don't need to use this one. You don't need it because the question is asking how much greater a return you will receive for the ETF. So irregardless of the gross return, compared to the mutual fund and ETF, how much greater you get, how much more you get from ETF. Actually, you can still calculate the gross return, but for the mutual fund, what you get is 20% minus 0.5% minus 2%. This first one is the expense ratio here. And the second one is the back end load. Back end load is when you exit, you have to pay the exit fee, is here. And for ETF, you earn 20% minus 0.1% expense ratio, and you don't need to pay the exit fee. So how much greater a return would you receive for the ETF? It's basically 0.5% plus 2% minus 0.1%. So it's 2.4%. So this one is higher than this one by 2.4%. Okay.
Could you define back end load and front end load again?
So this is the fee that you pay when you enter the mutual fund. It's something like when you go shopping, you want some membership and you have to pay like some fee, like Costco, for example. When you want to get in Costco, you have to pay the membership, something like that. When you want to enter this mutual fund, you have to pay some fee as a percentage. And this is a little bit rare in real life in other examples, but it's similar just when you exit the mutual fund, they will also charge you a fee. Like, yeah, for their commission, anything. By exit, I mean, you can retract the money, like you don't want to invest in them anymore. You just want to get all the money out, but you cannot get 100%. you have to pay them some extra fee to get out of the mutual fund.
So the back-end load is basically just a percentage of your initial investing, right?
I'm not sure actually. I think this one might be your final value.
So
Or okay, it might be directly deducted from your return. For example, here, like it's not based on your initial. Yeah, if it's deducted from your gross return, it will be based on your initial value. Yeah, it is. But I think usually what they do is, say during a period, you realize some 20% of return, you cannot get all of the 20% out. You can only get like part of it. And then by that definition, it's based on the initial value. Yes.
okay, thank you.
Mhm. So that's all for the first part. If I think I almost cover everything, although I didn't plan to do. Now let's move on to the second one. So let's see. Which of following best describes the risk of a security? A security. Then it's not standard deviation, it's the covariance. Basically, this is telling you it's beta. Again, when you measure the risk for securities, you use beta. For portfolios, you use standard deviation or variance. They're the same. Okay. Yeah. So which of the following measures the time weighted return? I wanted to say we will not test dollar weighted, so it's irrelevant. Time weighted return. I didn't cover this in class, but you should be able to tell from the compounding. So like geometric return allows compounding, and this one and B and D are just simple, no compounding. Standard deviation is just irrelevant. Why it is time weighted returns? Because think if you have some same return for a long time, like long period, because of compounding, their return will be very much more powerful if you compound it over longer term, right? Because of compounding, time plays a very important role here. As a result, you can, well, some people call it as time weighted return, although I usually don't use this term, but this is like how you understand why it's related to time because of the power of compounding. Okay. And the third one, difference between a investor and a gambler is in the slide. Basically, it's about if they require more reward for more risk. Gambler don't care about reward. Gambler just enjoy the feeling of taking risk, like going to casino. So, but investors, they require more. If they bear more risk, they want higher reward. So that's why B is right. Risk neutral is not true because investors require higher reward, higher risk premium for higher risk. Knows he or she will not lose money, this is irrelevant, right? Knows the outcome, no one knows unless God. Has come up with another name for gambling, I mean, it's irrelevant. So still, again, B should be very obvious. It's about for more risk, do you need more reward? Sorry, do you need more risk premium? If yes, then you're an investor. If no, then you're a gambler. If you calculate the historical dollar rate of return, annual geometric average return, and annual arithmetic average return, if you desire to focus the performance for next year, what's the best one? Arithmetic return. Again, geometric return is used for long-term performance. Arithmetic return is for short-term. Okay? Nothing more to say, it's just a recovered in cost. Holding period return is dividend plus price in the future divided by price today minus 1, 2.25 plus 28 divided by 29. Oh, I covered this one in class, right? Did I?
Yes.
Yeah, I covered this in class. And I also covered 6, 7, 8 in class. And 9, I remember Asim asked me this one.
Yeah.
10, I also covered. And yeah, 11 is related because you want to hold the fund until retirement. So it's usually use geometric average return, long term. And this one, 12, we also covered. Systematic risk can be diversified away. It's the opposite, right? Only idiosyncratic risk can be diversified away by investing in large number of securities. Systematic risk is the one that cannot be diversified away. 14, I covered. 15, I covered. 16, I covered. And 17, 18, I also covered. I remember we stopped at 25, right? Somewhere.
Yes.
Yeah, so I didn't cover 21 and 22. Let me talk about 21 and 22. So which of the following best describes the efficient frontier? The set of risky assets that provides the highest return for given portfolio risk is just another way to say, as I mentioned many times in class and in the practice question, efficient frontier is about maximizing expected return given a risk level, or equivalently minimize the risk given some expected return. Okay, so A is right. The set of available portfolio risk rating combination. This is investment opportunity set. The measure investment opportunity set. A measure of how much two securities moves together. This is covariance. Risky asset, risky portfolio with the highest Sharpe ratio. This is tangent portfolio. The upcoming Star Wars movie. Maybe. So 22, if all investors become more risk averse and the expected return on the market increases, the security market will what? So this might be a little bit hard. Just to remind you, what is the security market line? It's based on the CAPM, right? Expected return on security equals to risk-free rate plus beta I times expected return on market minus risk-free rate. This is beta. This is expected return on security I. Depends on the beta. Okay. This is RF. This is beta equals to 1. Then here is expected RM. So in the question, before that, this whole figure, this line is called SML, security market line. Okay. If investors become more risk averse, meaning they require more risk premium, it's equivalent to say that expected return on the market increases, meaning this one increases. Then what's gonna happen? This SML to go here. Because RF is not changed. And think as if this is y equals to a plus bx. And this x is beta. this A is the intercept, because this x-axis is a beta. And think the expected return on market, expected market premium is the slope B. So if this expected market risk premium increases, it means the slope is getting steeper. So A and B are irrelevant because it says it's shifting upward or downward. It's like still parallel. And if it shifts upward or downward, it means risk-free rate is changing. So it's not true. Have the same intercept, C and D are right in the first half, but D is wrong because it's not a flatter slope, it's a steeper slope, as in the blue line. Shift upward, no. Flatter slope, no. That's why C is right. Okay. I remember I covered 23 and 24. Let's start from 25. So use the table to answer 25 to 27. Let's look at it one by one. You determine that the tangency portfolio, same thing, has the expected return of 10%. What percent of your risky wealth is in OSU? Your tangent portfolio is divided in between OSU. Let's say you invest W into OSU and 1 minus W into BUCK. Your expected return has 10%, is 10%. It equals to W times 12%, which is the expected return of OSU, plus 1 minus W times 7%. This is expected return of BUCK. Then you will get 12% times W plus 7% minus 7% times W. You will get 3% equals to 5% times W. W equals 3 divided by 5 is 6%. Okay, so answer is C. Suppose your tangency portfolio has an expected return of 10% as above and a variance of 0.15. You have a risk aversion coefficient of 2. What percent of your total wealth will be in the OSU? This is exactly the example I give in class that I might test you, okay? So remember, when you construct tangency portfolio, think as if you're in the world of one risk-free asset and one risky asset. And this one risky asset is gonna be your tangency portfolio. Here, this one risky asset has a 10% of expected return and a variance of 0.15. Using the formula in the section 1 of chapter 6, suppose you invest Y in this one risky asset. Y equals to expected return of risky asset. Here is your tangent portfolio minus risk-free rate divided by A is your risk aversion coefficient times the variance of the tangency portfolio. So it's just a 10% minus risk-free rate is 3% divided by 2 times 0.15. So it's 7% divided by 0.3, right? So let me double check the answer. Yeah, so the answer is not, I mean, it's not the end yet. Let me calculate the answer, I would say. So it's around 23.33%. Okay, around 23.33%. Then it's asking you what percentage of your total wealth will be put in OICU. Remember, this Y is the portion that you invest in this tangency portfolio. And within the tangency portfolio, you already calculated, you put 60% in OICU. So in about your total wealth, in OICU will be Y times W. The W is the one we just get above. Then it's gonna be 7% divided by 0.3. I'm just using this number here, okay? Times 60%. Then how much is it? The number will be much nicer. So 7% times 60% divided by 0.3. And it's 14%. Okay. If you stop here and you choose A, you'll be wrong. Because this Y again is the total wealth you invest in both OICU and BUC. But how much is in OICU? You have to time the W. Answer is B. How much of your total wealth would you put in the treasury bill? It's going to be just 1 minus Y. So it's 1 minus 23.33% equals to 76.67%. B. Okay. For question 28, consider the historical return for the two stocks below. Which stock has greater return standard deviation? This, well, you can calculate it using your calculator, but this looks like a analytical question, but it's actually a qualitative. So it's just testing you if you understand what is standard deviation. It's just about which return moves around more volatilely, like has more volatility. And I even don't need to calculate, but I'm pretty sure I'm right. A is much more volatile. It goes 12 something percent all the way down to 2 something percent and go up to like 14 something percent and down to around 6% again. But DEF is always within very narrow range, like from 7% to 9%. So ABC gonna have higher standard deviation. But if you really want, you can calculate it. I'm pretty sure it's gonna be ABC. 29, you have a $1,000 portfolio consisting of Intel, GE, and Con Edison. You put $400 in Intel, $240 in GE, $360 in Con Edison. They have beta of these three numbers. What's your portfolio beta? This one is testing you. Portfolio beta is just a weighted average of individual beta. Here is beta of Intel times, the weight in Intel plus beta of GE times the weight in GE plus the beta of Con Edison, I will just say CE times the weight in Con Edison. Well, they are 1.7 times 40% plus 1 times 24% plus 0.8 times 36%. Let me double check the answer, although I think I did it earlier. Yeah, the answer is 1.048. This is pretty straightforward. But it's a detour. The answer is A, nothing to say about that. But did you see? GE has a beta of 1. It means it should, according to CAPM, it should have exactly the same return as the market portfolio because it has exactly the same systematic risk level as the market portfolio. Okay, and the first one, Intel has a higher systematic risk than market portfolio because it has beta greater than 1. And Con Edison has a systematic risk lower than 1, meaning it's less risky than market portfolio. Investors do what for stocks with negative alphas? Sell short. Why? Negative alphas are related to overpriced. Actually, Michael earlier today asked me about how to understand the alpha and the overpriced or underpriced. Let me illustrate a little bit more on this. So negative alpha is related to overpriced. Positive alpha is related to underpriced. How to understand this one? Think, for example, you know some friend who is working for Tesla's competitor, like another company, let's call it rocket company. And the rocket company has some special technique building a better rocket or a better auto-driving machine vehicle. But not many people know that, maybe because they don't have a good CEO or like popular CEO as Elon Musk. Their CEO might not be tweeting that much. So not many people know that. But actually their price, I mean, their product is pretty good and it's gonna be super influential in the future. Suppose your friend is working for the rocket company and he knows the inside information and he told you this and recommend you to buy the stock. And because not many people know that company yet, not knowing the company is that good yet, so the price of the stock is not super high. So you buy the stock at a really low price, and maybe 10 years later, rocket company published their beautiful, perfect product, and all of a sudden they get super successful, and your stock price goes up a lot, like maybe 100% or 200%. And that part of super big return usually cannot be explained by CAPM. Because think about it, why the company, if according to CAPM, if a company earns super high return, it should have super high systematic risk, right? But the company is purely just because they are not known by people. It's not because they have a lot of systematic risk. So that rocket company gives you a very positive alpha, meaning that they give you a very fat, very positive, abnormal return compared to what is predicted by CAPM. And those companies are underpriced. As I said in the example, you actually, not many people know that, or the demand is just too low compared to their true value. So they're underpriced, and you will earn positive, brilliant, great alpha by buying those undervalued stocks. In comparison, when you think about negative alpha, think some example as GameStop. Suppose you enter the GameStop during the peak period, after it's almost right before it started to crash. You actually earn very low return, very negative return. And the very negative return you earn from GameStop also cannot be explained by CAPM, because it cannot be the case that during that period, there is a gigantic systematic risk. Actually, that's not the case, because everyone knows it's driven by the retail investor. So during that period, you earn much lower return than the CAPM predicts, meaning you're earning very negative alpha. because you're holding overpriced stock. Think about it, right before the GameStop crashes, it's definitely overpriced. There is a huge bubble. So many people are there. Everyone is hoping the price going up, but actually it didn't. So the price, that super high price, is already not reasonable anymore. And that's why they are overpriced and they start to drop very fast. So that's like two real world, or Rocket is not real world, but it's kind of two examples to think about why positive alpha is related to underpriced stocks and negative alpha is related to overpriced stocks. And here in this question specifically, I detoured a lot, but back to this question, because you expect some stocks with negative alpha, meaning they are overpriced, right? So you want to short sell rather than buy it, okay? Question 31, when creating a portfolio, why is it related to the, oh yeah, oh yeah, it is related to the table. I was thinking why it's related to the table. So this is commodity and another risky portfolio, okay? When creating a portfolio, should an investor put any money in commodities? The answer is yes. Because of the negative covariance. So this question is testing you to understand the power of negative covariance. I mentioned many times in class, by holding assets with negative covariance, you will get really low portfolio risk or portfolio standard deviation. And on the other side, if they are perfectly correlated, you get nothing, like no diversification effect at all. So because usually people or most investors always want to pursue higher Sharpe ratio. So they always want higher expected return versus lower risk level. And because negative covariance can decrease your portfolio risk level. So although here the commodity has a lower expected return than risky portfolio and also higher standard deviation than the risky portfolio, although in terms of the return and risk trade-off, the commodities are terrible, but because they have negative covariance, they can improve your portfolio Sharpe ratio to an even higher level compared to this risky portfolio only. That's why you still want to hold it. And that's what A was saying. I mean, that's also why A is wrong, because A says, no, oil has a lower return and higher standard deviation. So it's a very bad deal. You don't need to hold it, but that's not the case because negative covariance can even improve more your portfolio performance, okay? True or false? 32. According to the CAPM, you can expect a return lower than the risk-free rate for securities with negative betas. That's true. So I'm pretty sure I mentioned this in class, but let me talk it again. I remember I even stopped to ask you guys that, okay, we know beta can be greater than 1, can be equal to 1, can be below than 1, can it be negative? And the answer is yes. If the beta is negative, this whole thing is negative, because usually the risk premium is positive. It's not usually, it has to be, otherwise people don't want to hold it, right? Because this part is positive. If this is negative, the expected return on the individual security will be lower than the risk-free rate. And so the answer is true for 32, but let me go slightly even more, repeat what I said in class in case you forgot. Negative beta securities are very popular because by holding a negative beta security, you actually decrease your portfolio beta a lot. I mean, you actually can decrease your portfolio beta because it's negative. However, in the real world, it's very rarely to see a security with negative beta. Usually those securities with negative beta are called hedge or insurance. Think about like insurance, for example. When does insurance pay you the most? It's when you suffer the most, right? Like think as if the market, when market is going well, like Apple or Google will also do well, like the whole economy is doing well. When the economy is not going well, those companies also not do super well. Those are the positive beta examples. But insurance are on the other hand. Insurance are trying to compensate for you when you are facing loss, when you are suffering. So for example, if there's a security that compensates your loss when stock market crashes by giving you some maybe like what was the like some package during COVID, like when the economy is locked down, you get some money from the government. So those kind of things are like insurance. So actually when things going wrong, things going bad, you get better return or better reward. Those kind of securities have negative beta. And that's what the negative beta means. And it's very popular because sometimes, like many times, you want to hold insurance just to compensate for the downturn, right? So it's a little bit more step more to understand what negative beta is. Okay, 33. Based on the outcomes in the following table, choose which of the statement below is right. The covariance of security A and security B is 0. See security B, these are 3 scenarios: recession, normal, and boom. Security A has a return greater than this ER is think as if it's fixed number or constant number. Security A does better in recession, similar as ER in normal, and it does worse than ER in boom. And security B is just a constant all the time. So the covariance of A and B is 0 because A and B are not moving around at all, because B is just a static, it's not moving at all. So A1 is right. Correlation coefficient between security A and C is negative. Its correlation coefficient, positive or negative, only depends on the covariance, because correlation equals to covariance divided by sigma 1, that's 1 and sigma 2, right? And the denominator always positive, so it's basically saying the same thing. The covariance between A and C is negative. It's yes, because when recession, security A return is higher than ER, but security C return is lower than ER. And normal, they are the same, but in boom, it's the opposite, you see? So they move to the opposite direction. So A and C are negatively correlated. B and C are positively? No, because B is static. B does not move at all with even if in any scenarios. So the correlation or covariance between B and C is also 0, the same as A and B. Answer is 1 and 2. 2 investment advisors, 34. 2 investment advisors are comparing performance. Advisor A averaged 20% return with a portfolio beta of 1.5. Advisor B averaged the 15% return with a portfolio beta of 1.2. Treasury bill is 5%. Market return is 13%. Which advisor is a better stock picker? This is exactly testing you. One of my favorite example in class, using alpha to measure underperformance or overperformance. So let's see. You should not directly compare advisors A return and advisors B return, because you have to adjust it for the market risk. Let's see alpha. advisor A's alpha. Alpha A equals to 20% minus risk-free rate 5% plus 1.5 is its portfolio beta times 13% minus 5%. So this thing here is the predicted expected return according to CAPM. Okay. And what's the answer? Let me calculate. So it's 20% minus 17% equals to 3%. This is alpha A. And then let's see alpha B. Alpha B is 15% minus 5% plus 1.2 times 13 minus 5%. It's 15% minus, let me see, 14.6%. It equals to 0.4%. Okay, so accidentally, A is doing better, but it's not because A earns higher average return. It's because A earns higher alpha. And B, C, D, E are just wrong. A is right. And C is not right not because of the higher return, as I just said. Okay. 35. Stock have a beta of 1.3. Systematic risk of stock is higher than the stock market as a whole, because stock market beta is 1. What is the EAR for this new car costs? New car, okay, the loan has a 0.8% per month, and there are 12 months in 1 year. So EAR is, again, has compounding. Let's see how much this is. -1. So it's just a 10.03%, right? So answer is D. It's just a formula sheet. 37, you invest all of your money in 1 year treasury bills. Which of the statement is correct? Your nominal return on the treasury bill is riskless. 1 is right, because by investing in, at the time when you buy the treasury bill promises you some yield, some return. That is nominal return. Unless you buy tips, it adjusts the return. But for normal treasury bills, it's nominal return guaranteed. And what you're gonna expect is at the end of the year or like 6 months, you're gonna get the nominal return that they promised to you for sure. So that nominal return is riskless. Your real return is not riskless because of inflation. You don't know what your real return will be. By riskless, it means you are sure what the return will be. But as we used the formula already, your real return equals to 1 plus nominal divided by 1 plus inflation minus 1, right? You know this one for sure, but you don't know what the inflation will be. So you are not sure about what your real return will be. So it's not riskless. And for 3, you expect a lower return than S&P 500. Yeah, because it's risk-free and higher risk, higher return. So 1 and 3 are true. 38, consider an investment opportunity set formed with 2 securities that are perfectly negatively correlated. The smallest standard deviation you can achieve is always what? It's 0. This is exactly a reframe. Another version of the question asks you, the upper bound and the lower bound on your portfolio if you invest in too risky assets. The upper bound or the highest portfolio standard deviation you can get is just the weighted average of the two standard deviations. And the lower bound or the lowest one you can get is gonna be absolute value of the difference between these two. And suppose you know what is sigma, standard deviation 1, standard deviation 2, you can make it to 0. How to do that? Just make W1 sigma 1 minus W2 sigma 2 equals to 0. And because W2 equals to 1 minus W1, right? So W1 sigma 1 minus 1 minus W1 times sigma 2 equals to 0. It is W1 sigma 1 minus sigma 2 plus W1 sigma 2 equals to 0. So W1 equals to sigma 2 divided by sigma 1 plus sigma 2. If you invest this portion in security 1 and the leftover in security 2, and if they have perfectly negatively correlated, you will get 0 on you'll get 0 standard deviation of your portfolio. Okay. So again, lower bound can be 0 if they are perfectly negatively correlated. And if are perfectly positively correlated, you can only get weighted average. 39. The value of beta coefficients of securities are what? Always positive, not necessarily, right? As I told you, it can be negative. Always negative? No, most of the time it's positive. Never negative? No, it can be negative. Always between positive 1 and negative 1, there's no, you can have a beta greater than 1, right? If it's riskier than market. So just the E. As I said, most of the securities are positively correlated with the aggregate market movement, but there are some insurance or hedge securities which have negative beta. Okay. 40, decreasing the number of stocks from 50 to 10 would likely what? So remember, the more stocks you have, lower idiosyncratic risk, and eventually you can cancel out that one. But it does not affect systematic risk at all. So if you decrease is the opposite logic of this one, right? It will increase the idiosyncratic part, which is the unsystematic risk. That's why B is right. A is wrong is because you cannot diversify away or undiversify the systematic risk anyway, so it's wrong. You cannot increase the return of the portfolio because return of the portfolio has nothing to do with number of stocks. Okay. Decrease the variation in returns in the investor faces in any 1 year. Well, it's just off track. You cannot predict how does the variance in return in any 1 year, right? So you might increase or you might decrease. Decrease the standard deviation of the portfolio is exactly opposite. It will increase the standard deviation of the portfolio because it have more unsystematic part or the idiosyncratic part. So B is right. 41, I actually described earlier about on the earlier question, but let me briefly say it again. If a security beta coefficient is negative, it means its return are negatively correlated with the market. In other words, during recession, the return actually is good. It's like insurance. It's like when car crashes, someone compensates your payment to the repairman store, for example. Those kind of hedge or insurance securities will have negative beta. Okay, if the returns are positively correlated with market index, it will have positive beta. From math perspective, if the covariance is negative, then it means beta is negative. So B is wrong. Its stock price has historically been very stable. Well, this is about idiosyncratic volatility. It has nothing to do with the beta. Market demand for the firm's share is very low. It's irrelevant to beta. If the stock has recently experienced a high return, I mean, all of the CDE has nothing to do with the covariance with the market. It's all about its individual stock return performance. Well, you can observe it, but it cannot tell you anything about if the stock is moving with the market or not. And beta, again, is only about co-movement with the market, not about its own volatility. Okay, so CDE are totally wrong in this sense. 42. Investing in two assets with correlation coefficient of 1 will reduce which kind of risk? Again, I mentioned it earlier. Correlation coefficient equals to 1 is equivalent to saying perfectly correlated. Upper bound of the portfolio will be just the weighted average of the standard deviation. And if you visualize it, visualize the portfolio's expected return and portfolio standard deviation, security 1, security 2, you will just get a line rather than this. If you don't have perfectly correlation, you might get a curve, right? So there's no diversification at all if they are perfectly correlated. So E is right. It cannot reduce any type of risk. Okay. 43. The figures below shows the plot of monthly excess return plotted against excess return for market. So this is market minus risk-free rate. This is market. This is excess return or return on A minus risk-free rate and return on B minus risk-free rate. Which stock is likely to further reduce risk for investor currently holding her portfolio in a well-diversified common stock? The answer is stock A. Why? Because if you look at the pattern of security B, it's almost perfectly correlated with the market. So I'm pretty sure this stock B might have beta very close to like 1, or actually beta is irrelevant here. So the thing is in 43, because beta is almost perfectly correlated with the market, and because the investor already hold a well-diversified portfolio. Well-diversified portfolio meaning it already try to include as much stocks as possible. Might be very similar to market portfolio already. Then including stock B will not be helpful because there will be no diversification at all. Let me repeat it. The well-diversified portfolio, think as if it is similar to the market portfolio, because market portfolio is the most well-diversified portfolio. Okay, it includes all the, it reflects the whole aggregate stock market. And the investor already hold a pretty well-diversified portfolio. it means these two will be very similar. And because B is perfectly correlated with market. What does it mean? It means adding B into the portfolio will not actually have diversification effect anymore. Again, if you want diversification effect, you want at least not one, like not correlation coefficient equals to one, right? You want the best way is negatively correlated, but at least not correlated would be helpful. And if you look at stock A, these dots, it's kind of random. When stock return is higher, I mean, when market return is higher, the stock A return sometimes higher, sometimes lower. And when stock market return is lower, stock A return sometimes higher, sometimes lower. So it's kind of not really correlated. This is something you want. Not correlated means there is some diversification effect at least, although not as good as the negatively correlated, but there is some correlation. So A would be better. Okay. Then 44. Which of the following would be considered as a risk-free asset in real term as opposed to nominal? This is just the definition of the tips. Okay, you need to check the definition. So again, tips, treasury T-bond whose return were indexed to inflation will adjust for inflation risk. 45. Your great aunt Zella invests $100 in 1925 and earned a compound return of 10% annually. How much it's worth 90 years later? Very simple, just to plug in the compounding return formula. Remember to times the $100 at the beginning. So it's $100 times 1 plus 10% to the power of 90. Let me double check the answer. Yeah, it's $531,000, 302. Simple. 46. Suppose a security A has an expected return of 12%, beta of 1.5. Security B has an expected return of 4% and a beta of 0.75. Expected return on market is 8% and risk-free rate is 3%. What portfolio can you create to earn a positive alpha and take no systematic risk? Okay, so first of all, let's get rid of the positive alpha part. Let's think about no systematic risk. What does it mean? It means beta equals to 0. Okay, so suppose you want to get beta equals to 0. What should you do? Again, the portfolio beta is the weighted average of every single individual asset's beta. Suppose you invest WA in A, WB in B, and leftover in risk-free rate. Your portfolio beta will be WA times 1.5 plus WB times 0.5 plus 1 minus WA minus WB times 0, because risk-free rate has no no beta. The beta is 0. I was a little bit hesitant because there is a market also. So market has the beta equals to 1. But yeah, let's suppose we just stick to security A and security B. If you have market, say market, W market, you can just add market later on. But let's see here for first of all. And this portfolio only from security A and security B is just WA times 1.5 plus WB times 0.75, right? Then, because this part I cancel out, how do you make this portfolio beta equals to 0? You want to invest WA to WA equals to minus WB, right? It's just to cancel out the 0.75 term. So in other words, WA should be minus half of WB. This is one way to do that. And you can see here, apparently A satisfies this, and you can check if it has positive alpha. So let's see, for example, in the A choice A, if you get, sorry. So if you invest in this A choice, what's your expected return? Your expected return will be 30% times 12% minus 60% times 4% and plus 130% times risk-free 3%. And how much is this one? Let me see. 30. It equals to 5.1%. And do you see? This is greater than risk-free rate. Remember, this portfolio has a beta equals to 0. So if the beta equals to 0, according to CAPM, you should earn a return that has a risk-free rate or exactly same as risk-free rate. If this return is greater than risk-free rate, actually you're earning a positive alpha. So A is the answer. And let's see BCD. So like see B, the expected return will be 100%, 140% times 12% plus, not plus, minus 40% times 8%, not 8%, 4%. Actually, yeah, the return is irrelevant. You can still calculate it, but it's irrelevant because this portfolio, like all of the other BCD portfolios, does not have beta equals to 0. Because if you only invest in AB and treasury bill, if you want to get your portfolio beta equals to 0, you have to satisfy this relationship. Okay, so if you want to, again, if you want to build, because A, B, C, D are based, all the choices are based on investing in security A, security B, and treasury bill. If you have like some choices which will include market portfolio, that's another story. But if you focus on security A and security B and treasury bill as in the A, B, C, D choices, and you want to get a beta P equals to 0, the only thing you can do, or the only way you can get, is to satisfy the relationship I just highlight. So WA has equals to be negative half of WB. And all of BCD, they might have positive alpha if you calculate the expected return and the portfolio beta, but their portfolio beta cannot be 0. So BCDs are wrong because these relationships 140, negative 40, and 2080, this relationships does not satisfy this relationship here. So the beta P cannot be 0.
So do we need to know how to calculate the alpha?
Yeah, you need to know how to calculate the alpha, of course. So for example, let me show you the B. Let me give you an example of B. So the B's expected return is here. Minus 40% times 4%. This is 15.2%, right? The B portfolio. And the B alpha is 140 times 1.5 minus 40% times 0.5. So it's gonna be 140 times 1.5 minus 40% times 5. The beta is 1.8. So according to the CAPM, what's the expected return from CAPM? It's gonna be, this is CAPM, 3% plus 1.8 times 8% minus 3%, right? So this is 3% plus 1.8 times 5%. It's actually 12%. So according to CAPM, and based on the beta you get, and this is your expected return on the portfolio, and this 12% is CAPM prediction. So you are actually earning a positive alpha. It is right, you are earning positive alpha, but it's not systematic risk free because your beta is 1.8, it's not 0.
Okay, I see.
Yeah. And you can do the CD as well, and you're gonna find maybe positive or negative alpha, but it cannot have a beta P equals to 0. Okay, 47, I think this is the last one. Yeah, we are about to, I'm a little bit brainless, getting more and more brainless. So which of the following is true? If the expected, let's see it one by one, although C is the right one. Let's see A. If the expected return on the market is high, your expected return for holding high beta stock will not be affected. That's not true because, let me write CAPM here, RF, no, expected return equals to RF plus beta I times expected market return minus RF, right? So what A is saying, if this guy increases and this is high, then this guy will not change. That's not true because if this beta I is very high positive, if EM increases, this guy will also increase. So A is not true. And let's see B. If the expected return on the market is high, same thing. You expect an especially low return for holding high beta stock. That's not true because, again, as I said, high beta stock should give you higher expected return when market return is higher. And this is exactly what C is saying. Expected return on the market is high, you expect a large return for holding high beta stock. Okay, and what D is saying is if expected return on the market is high, you bear more risk for holding a high beta stock. So if you only look like at the last half, Actually, it's not so false, but it's wrong because of the first half, actually. If the expected return on the market is high, it has nothing to do with you bear more risk, because bearing more risk means you hold very high beta stock. It doesn't mean like when the expected return on market is high, it doesn't change your risk level actually, because the only thing that change is beta. It's not the market expected return. So in other words, what D is saying is that, okay, when this guy increases, you get higher, you get more risk. That's not true. That has nothing to do with risk. So D is wrong. And E, if the expected market return is high, you bear less risk. It's same logic. Like higher expected market return has nothing to do with your risk level. Risk is only related to beta. Okay, that's all I have for today. Any other questions? Yurian, do you have other questions?
I am a little confused when you said because the risk is only related to beta.
Where are you confused?
Hold on, let me think about it a little. So does risk has anything to do with beta?
It has, but what D and E are saying is that if the expected return on RM increases, your beta will increase, or you will bear more risk.
Oh, I see.
Yeah.
So generally the expected return has nothing to do with the beta.
Exactly. Again, beta is about covariance between RI and RM. Well, RM can be very low or very high, but it can move irregardless of its expected level.
So does high beta necessarily means that high risk?
High beta means high systematic risk, yes. But high beta does not mean high expected RM. It's irrelevant.
But aren't we like told that high risk usually comes with a high return?
Yeah. High beta will imply high RI, but not RM. So high beta means this individual security is riskier. So the individual security has higher expected return. But why is it about the market? It's not about the market.
Oh, okay, I see.
Yeah. Any more? Everything else are clear?
Yes, I think so.
Okay. So I will end up here. I assume Yuran kind of represent maybe most of your opinion. If she thinks most of things are clear, it should be quite clear. But if you do find something confused, please send me an email. I really hope you can do well on the midterm. Okay, I will try not to surprise you on the midterm, and good luck with everything.